In this video demonstration, we're going to be looking at a particular triangle group where the results, the answers given by link ratio type methods are much too large. Let's see why. So we enter this particular triangle group. We highlight the paid losses cumulative. We click on the ELRF modeling framework, and the starting model is what is now commonly called the Mack method, or equivalently the volume-weighted averages ratios, but they are calculated as regression estimators for the origin. So these are the volume-weighted averages between every two set of contiguous development years. These are the residuals. And let's look at the residuals versus the calendar year. And you'll notice that the distinct downward trend. Now, the method, the Mack method, does estimate some trends in the data, but we don't know what they are. We don't know what trends are in the data. We don't also know what trends are in the method. However, we do know the difference. So the residuals represent the observed minus the fitted. Now, it appears that the observed trend must be much lower than the trend in the method, because the difference between the two is a negative trend. Let's look at an example of such a scenario. Let's suppose that the observed trend, the actual trend in the data, I've got my pointer, the actual trend in the data is actually 10%. So in the observations you have a 10% trend. But the method, for some reason, actually estimates a 20% trend. So you can see the method, the trend in the method is much higher than the trend in the data. Let's look at the difference between the two. The residual equals observed minus fitted. So the observed is here, and the fitted the observed is here, and the fitted is here. So the observed minus the fitted is positive. Then the observed minus the fitted gets smaller, still positive, 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 then it's 0. Then the observed, which is here, and the fitted, which is there, becomes negative, but in absolute terms larger, 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 larger in absolute terms. Now let's look at these residuals. We see a similar display here. Observed minus fitted is positive, then it gets close to 0, then on the average it becomes negative. So the answer we get now is based on a trend which is much higher than the trend in the data. And if we just look at our logbook, we have a mean of 896 million, T stands for thousands, and the standard deviation is 104. Now, these numbers, in my view, are really all meaningless, because an assumption in the method violates what in fact is going on in the data. If instead, well, let's use the arithmetic average instead, where we just set the delta term, the variance of the error structure, to be proportional to the cumulative squared in the previous period, and then if we do our forecasting, we find that we get a mean over 1 billion. Again, in my view, both those numbers are actually quite meaningless, because there's something in the method, a huge trend in the method, but it's not in the data. If instead now we try and capture some of that trend in the data, let's do that by adding a trend component in the incrementals, still including a ratio and an intercept. We now see that we have a method that better captures the actual trend in the data. Why don't we move these earlier years if we estimate now, optimize a couple of times. If we now look at the regression table, you'll see that most of the ratios are actually equal to 1. So we rarely use those. We more often use intercepts or a trend in the incrementals. And this method, which hasn't got nice simple descriptors, does have a trend in it, or it captures a trend which is more in keeping with the trend in the data. And of course our answer now would drop quite markedly. So if we now look at the logbook, it's about half, or nearly half, the answer we get when we use the ratios. Now let's do a simulation that actually illustrates these ideas. So let's re-estimate the volume-weighted averages as regression estimators, or if you like, the Mack method, where we get these residuals. Why don't I go to another triangle group, SDF, and here I'm going to simulate a triangle that has certain characteristics. What are going to be the features of this triangle? So let's go to triangles, highlight this one, let's do a simulation. We'll do a simulation where the level is 10, the actual inflation is 0.1, in other words it's 10%, the decay parameter is 30%, and the variance of the normal distribution, say 0.08, and this will be called PLI Sim 11. It will have these features. That will be the variance of the normal distribution around the trend structure, has a level of 10, inflation of 10%, that's a calendar year trend, and a 30% decay along the development years, which is constant. And let's save the model parameters for this data set, and let's call it iota equals 0.1, say, G equals minus 0.3. But actually, there's no need for me to save the triangle or the parameters for the triangle in that way, because once we save it, it in fact does save the parameters. That's the triangle. If we go to models and we go to simulation 11, if we go to parameters, there they are. If we run them, well, these are actually the parameters that created the data. This is the decay of minus 30%. It's not estimated from the simulated data. That is, in fact, the true decay. That's the true alpha value that we used, and that's the true inflation parameter, and that's a maximum likelihood estimate of the variance of the normal, which is a little bit less than 0.08. Now, if we estimate the true parameters of the model, we know the true parameters, but let's estimate, because we do have random variations around the true trend structure. If we estimate the parameters, that's the estimate of the minus 0.3, that's the estimate of the 10%, and that's the estimate of the 10, of the level, and these are the residuals. Now, if we set, also, and you can see an outlier down here, if we set the let's close ELRF. If we set the inflation to 0, then the trend in the method is much lower than the trend in the data, and you'll see that the residuals are growing. Let's estimate the trend in the data, which is around 10%. If we do our forecast now, we'll forget about this outlier. Forecast now, let's see what kind of answer we get. We have a mean reserve of 1.7 million. That's the standard deviation of the reserve distribution. And going forward, we assume that the actual trend comes from a distribution that has that mean and that standard deviation. Why do we now set the trend to exactly 20%? We know the trend in the data is 10%, but don't we set the trend in the method to be, say, 20%, which is obviously much higher than the trend in the data. So now I've set it to exactly 20%. So if you look at the actual model now, you'll see that the actual trend has been set to 20%. If we now look at the trend in the residuals, you can see it's negative, because that negative trend is approximately the 10% minus the 20%, which is minus 10%. In fact, if you were to take these residuals and put them in a spreadsheet, you can get a hard copy of them, put them in a spreadsheet, and on graph paper you actually measure that trend, then you'll find that that trend is approximately minus 10%. If I do a forecast now, of course it's going to be much larger because now I'm using a 20% trend going forward. So if you look at the difference in the two answers, excuse me, it's more than double the answer you get if you assume a 10% trend. If we now compare that with this data, a triangle group is open. If we go back to ELRF and look at these residuals and compare them, you'll see that they look very similar. This is where I actually use the trend of 20% when I know that the trend in the data is 10%, and this is the trend you have in the residuals, a strong negative trend when you use the Mack method, or volume-weighted averages as regression estimators for this particular portfolio here, paid losses cumulative. Okay. So, if you have the ELRF module of ICFAS Plus, you can find out very quickly whether the method you're using, volume-weighted averages or any average, doesn't give an answer that's too high, much too high, doesn't give an answer that's too low. But you still have your hands sort of behind your back in the sense that you don't have any descriptors in this modeling framework of the actual sort of features in the data in a simple fashion, something that is easily interpretable. You know that on this side we always have a model display that basically four graphs, four model displays that actually describe the features in the data in a kind of simple interpretable way. Okay, and also when you do your forecasting here, going forward, your assumptions are quite explicit and are conditional on all your distributions that you obtain are conditional on those assumptions going forward, and those assumptions can be related to the past. If I now go back to this cumulative triangle, or this particular portfolio, we do have models for the paid losses, case reserve estimates, and the number of claims closed. Now let's run these models. I've got a model for the paid losses, I've got a model for the case reserve estimates, and a model for the number of claims closed. Let's run those two models. And now let's just compare them. Now you'll see that along the accident years, a strong correlation. This is the case reserve estimates. These are the paid losses. You can see they're highly correlated. And this is the number of claims closed, not as highly correlated. Along the calendar years, the number of claims closed is actually a negative trend more recently. For the case reserve estimates, there are high trends in the early years, then it settled down to zero. Whereas for the paid losses, the trends are actually reducing. So you've got a high trend in very early years, and then the trend gets less and less. So it's 65%, 47%, 18%, and 8%. If we continue with a forecast of 8%, say, assume that for the future. So assuming for the future, we have a trend that comes from a normal distribution, mean 8.71%. That's standard deviation. Our mean reserve is 593 million approximately, and then the standard deviation of the reserve distribution is 42 million. Now on the other side, when we're using ratios, we got over 800. What if instead we assumed that this high trend of 18.28% actually re-emerged starting in 1991? What kind of forecast will we get? Well, I've actually saved the scenario, so I'm just going to load it and do a forecast with that, and we get somewhere around 751.9 million with a standard deviation of the reserve distribution of 79.5 million. So you can see in PTF I do have control on my assumptions going forward. I don't have that in the extended link ratio family. It's impossible to have control on any sort of assumptions going forward. Now, if we again look at the three model displays for the three data types. Now, Windows, by timing again, it's kind of switched around. So on the right, we have the number of claims closed. Now, there's a negative trend. That means the number of claims open, I don't have that array, because to calculate that array, I would have to have the number of claims reported, which I don't have. That means the number of claims open, there's probably likely to be a positive trend there, definitely not a negative trend. The case reserve estimates are flattening out, there's a zero trend, but yet the paid losses are still increasing. So it's almost like the case estimate per open claim are probably going down. That means the people calculating the case estimates presumably are thinking that in terms of the future paid losses, the trend is obviously not going to increase, if anything might decrease. Yet if we assume a trend of 8% plus minus 8.7 plus minus 0.97%, we still get a much lower number than we do when we use the volume-weighted averages of the Mack method. If we reverted to a trend of 18.28%, which is very unlikely given what's going on in the case estimates and the number of claims closed, we still get a mean which is much lower than the one obtained by using link ratios. Okay, so this example I think is quite powerful in exhibiting a number of things. One, that link ratios can give you answers that are much too high, and two, that when you model the paid losses, incremental paid losses, case reserve estimates, the number of claims closed, in the PTF modeling framework, you actually extract much more information, and you're in a much better position to make assumptions going forward. And you can also monitor those assumptions. Next year, if you update the whole triangle group, you can actually find out almost immediately, did it continue with this trend, did it revert to this trend, or perhaps it actually, the trend actually reduced for the paid losses, given the information in the case estimates and the number